Technical Analysis Part 2, The Pro Edge. You've been losing to the institutions. But what if you could see what they see? Welcome back to the Foundation, Phase 3. By the end of this masterclass, you won't just trade price, you'll trade the orders behind it. Here's why retail traders fail. You've learned the structure. You've drawn the trend lines. You've watched every YouTube tutorial on support and resistance. Yet, you still find yourself being hunted. You identify what looks like the perfect entry. Price moves exactly where you predicted. You enter the trade with precision. And then, it hits your stop loss. Your heart sinks. You close the position. And seconds later, magically, price moves in your direction. You weren't wrong about the direction. You were just hunted. You aren't unlucky. You aren't dumb. You were the liquidity. The institutions needed your stop loss to move price. And they got it. This is the retail trap. Today, we fill the final gap. We're moving beyond the basics into the pro edge. We're looking at supply and demand, smart money concepts, order blocks, and fundamental movers. By the end of this masterclass, you won't just see price. You'll see the orders behind it. You'll understand why price moves the way it does. And more importantly, you'll know how to profit from it. Section 1. Supply and demand, the bank's footprint. Let's start with the foundation of institutional trading, supply and demand. Now, most trading tutors will tell you that supply and demand is just fancy terminology for support and resistance. They're wrong, and this misunderstanding is why they're still losing money. Here's the critical difference. Support and resistance are static levels. They're like a floor and a ceiling. Price bounces off them. Sometimes it breaks through them. But they don't tell you why price is bouncing. Supply and demand zones are different. These are areas where a massive imbalance occurred. Where big banks, we're talking about the institutions that move billions of dollars, literally couldn't fill their entire order in the time they needed to. When this happens, price moves violently away from that zone, leaving behind a void. A gap, an imbalance, and this imbalance acts like a magnet. Eventually, price returns to that zone to fill the void and restore balance. Here's the key rule. We look for imbalance. An imbalance is a rapid, aggressive move away from a zone that leaves a clear void on the chart. Not a slow drift, not a consolidation, an aggressive, sharp move. The validation rule. A high-quality supply and demand zone must result in a break of structure, or BOSS. If price doesn't break the previous swing high or swing low after leaving the zone, the banks aren't using it. The institutional money isn't there. Skip it. Why? Because institutional traders don't waste time with weak zones. They use the strong ones, the ones that force price to break structure. The pro tip: strength assessment. Don't trade every zone you see. I know it's tempting, but here's where most traders fail. If price spends too much time consolidating inside a zone, bouncing back and forth, the zone is losing strength. The imbalance is disappearing. What we want is a sharp, violent reaction. The kind of move that suggests the institutions are done with that zone and moving on to hunt elsewhere. When you see that sharp move away from the zone, that's when you mark it. That's when you prepare to trade it. Section 2. Smart Money Concepts, SMC, and Liquidity. If you want to trade like the 1%, you must stop thinking like the 99%. The 99% are taught to trade double tops and double bottoms. They're taught that a perfect V-shaped reversal is a buy signal. They're taught that support and resistance are sacred. But the institutions, they think differently. Liquidity, sweeps, the hidden hunt. Those perfect double tops and double bottoms that you learn to trade. Those are called liquidity pools by the institutions. And here's the brutal truth. The institutions created those patterns specifically to hunt your stops. Here's how it works. The institutions want to buy. But they can't just buy without moving price up. So what do? They short. They push price down below the recent low. They hunt every stop loss below that low. They collect all the liquidity they can. And then, once all the retail traders have been stopped out, they reverse and move price violently upward. This is called a liquidity sweep, or sometimes a liquidity hunt. And if you don't understand this concept, you will always be on the wrong side of these moves. The pro rule: wait for the sweep. When you see a potential double bottom or double top forming, don't enter yet. Wait for the potential sweep. Watch for price to violently break below the low of the pattern and trigger all the stops. Once those stops are triggered, once the liquidity is collected, then you enter. This changes everything. Order blocks. The institutional buy signal. Now, let's talk about order blocks. An order block is the last candle, or the last few candles, before a major institutional move. Think of it as the institutional gather before the storm. Visually, an order block is typically a large, strong candle. When you see a large bullish candle followed immediately by a sharp move downward, that large candle is the order block. The institutions placed their massive buy orders during that candle, and then they pushed price down to collect retail stops below that order block. Why? Because they know retail traders will place their stops just below that block. And they want to hunt those stops to collect liquidity. Once the stops are hunted, price reverses sharply upward. This is your signal that an order block has done its job. The setup. Order block plus boss. Here's where it gets profitable. You identify an order block. Then you wait for price to break below it and collect the stops. Then, you wait for price to break back above the order block level and trigger a break of structure. That boss above the order block. That's your entry. That's when you know the hunt is complete and the institutional move is beginning. Fair value gaps, FVG, the magnetic zones. Finally, let's talk about fair value gaps, or FVGs. Here's the concept. Price is always trying to be fair. When price gaps, when it moves too fast and skips levels, it leaves a void. A zone that wasn't filled. This void is called a fair value gap. And here's the important part. The market hates unfilled voids. Price will eventually return to fill that gap. It's like a magnet. For us traders, this is useful in two ways. First, if we're in a trade and price is moving in our favor, we know the FVG is a logical area where price might pull back or consolidate. So we can use it as a target for a partial take profit. Second, if we're looking for a new entry, and price is far away from an FVG, we know price will probably return to fill it. So we can wait for that return and enter near the FVG with higher probability. The confluence play. Here's where it all comes together. When an order block aligns with an FVG, and both are near a supply and demand zone, and price breaks structure, that's a confluence setup. That's a high probability trade. Most retail traders see one or two of these elements. The 1% see all of them aligning. That's the edge. Section 3. The Fibonacci Masterclass. Most retail traders approach Fibonacci with reverence. They think it's a magic tool. They draw fibs on everything. And they wonder why it doesn't work. The problem? They're using Fibonacci wrong. Fibonacci is not a signal. Let me be clear. Fibonacci levels are not signals. They're not magic numbers that guarantee a reversal. If you're trading Fibonacci levels in isolation, you're gambling. But Fibonacci is an excellent confluence tool. The golden zone. 61.8% to 78.6%. Here's the truth about Fibonacci that most don't teach. The most powerful Fibonacci zone is the 61.8% to 78.6% range. Here's why. When price retraces from a major move, it typically retraces between 50% and 78.6%. But retail traders congregate around the 50% level. They all place their orders there. So the institutions, they skip over it. The 61.8% to 78.6% range is where the real institutional buy orders sit. This is called the golden zone. How to use it. Confluence. Here's the power move. You identify a major swing in price. You draw your Fibonacci retracement. You note where the 61.8% to 78.6% range falls. Then, you check if that golden zone aligns with an order block or a supply and demand zone. If it does, that's a setup. The institutions are positioned at that level, and Fibonacci has predicted where price will retrace to find support. When these align, when the golden zone sits exactly where your order block or demand zone is, that's a high probability entry. The overlay strategy. Advanced traders use Fibonacci in a different way. They overlay multiple Fibonacci retracements from different timeframes. The daily Fibonacci might show the 61.8% at 1.1050. The 4-hour Fibonacci might show the 78.6% at 1.1048. When these levels stack on top of each other, when they form a tight zone, that's a pillar of support. Price will respect that zone like a wall. This is how you stack the deck in your favor. This is how the 1% use Fibonacci. The anti-pattern. Avoid the 50%. One final note. If price retraces only to the 50% level and bounces, be cautious. This usually means the move isn't finished. The institutions haven't stepped in yet. Wait for price to retrace deeper into the golden zone before committing your capital. Section 4. Multi-timeframe analysis, the top-down edge. Trading without top-down analysis is like driving a car at night with your headlights off. You might get lucky and reach your destination, but you're far more likely to crash. Most retail traders miss this fundamental concept. They stare at a 5-minute chart and try to make trading decisions based on what they see there. But the 5-minute chart is noise. It's just the technical details of a bigger story being told on the daily and weekly charts. The narrative. The daily and 4-hour charts. Here's how professional traders think about timeframes. The daily chart tells the story. The narrative. Where is price going over the next few weeks? Is it in an uptrend? A downtrend? A consolidation? The 4-hour chart confirms the narrative or warns you if it's breaking. This is the macro perspective. This is where you understand the big picture. The execution. The 15-minute and 5-minute charts. Once you understand the narrative, you zoom into the 15-minute or 5-minute chart. This is your micro perspective. This is where you execute. You don't trade off the 15-minute chart in isolation. You trade the 15-minute in the context of the daily narrative. The strategy. Alignment creates high-conviction trades. Here's the professional method. Step 1. Look at the daily chart. Identify where a major support or demand zone sits. This is your macro-level target zone. Step 2. Wait for price to approach that zone on the daily. Step 3. Once price is in the zone on the daily, drop down to the 15-minute chart. Step 4. On the 15-minute, wait for a lower time frame break of structure. Wait for price to break the previous swing high or swing low on the 15-minute. Step 5. That boss on the 15-minute, happening within the daily zone, is your entry signal. Why does this work? Because you've aligned two narratives. The macro, the daily, is supporting a move, and the micro, the 15-minute, is confirming the entry timing. When both timeframes align, the probability skyrockets. The confirmation pattern. The 1-hour bridge. Advanced traders add one more layer. The 1-hour chart bridges the gap between daily and 15-minute. If the daily is in an uptrend and the 1-hour is also in an uptrend, and the 15-minute is forming a boss entry signal, you have 3 levels of confirmation. This is almost a guaranteed entry. The anti-pattern. Divergence. Be careful when timeframes diverge. If the daily is in an uptrend but the 4-hour is rolling over, showing signs of a downtrend, be cautious. Conflict between timeframes means lower probability trades. Wait for alignment before risking capital. Section 5. Fundamental analysis, the news. You've learned the technical map. You know how to read price action. You understand institutional structure. But there's one element that most retail traders completely ignore, and it's the most important one. Fundamentals. You can have the perfect technical setup, all the confluence in the world, but if you're on the wrong side of the fundamental narrative, you're going to lose. Technicals are the map, but fundamentals are the fuel. Think of it this way. Technicals tell you where price is going. Fundamentals tell you why it's going there and how fast it will move. Most retail traders focus 100% on technicals and ignore fundamentals. The 1% do the opposite. They understand the technical map, but they use fundamentals to confirm whether to trade it. The big two, CPI and NFP. When we talk about Forex fundamentals, 2 events matter above all else: CPI and NFP. CPI, Consumer Price Index. CPI measures inflation. How much are prices rising for consumers? When CPI is high, inflation is high. This forces central banks, like the Federal Reserve, to raise interest rates to combat the inflation. Here's the chain of logic. High CPI leads to central bank raises interest rates, which leads to currency becomes more attractive, which leads to currency strengthens. For example, if US CPI comes in hot, higher than expected, the Federal Reserve will likely raise interest rates. Higher U.S. interest rates make the dollar more attractive to global investors. Demand for the dollar increases. The dollar strengthens against other currencies. This is why you see massive USD rallies after hot CPI prints. NFP, non-farm payroll. NFP tells us how many new jobs were created in the U.S. economy last month. It's the most direct measure of employment health. When NFP is strong, more jobs created than expected, it suggests the economy is healthy. This makes the Federal Reserve more confident to raise interest rates if needed. When NFP is weak, fewer jobs than expected, it suggests economic slowdown. The Federal Reserve might hold rates steady or even cut them. The logic: strong NFP leads to economy is healthy, which leads to rates likely to rise, which leads to USD strengthens. Weak NFP leads to economic slowdown, which leads to rates might fall, which leads to USD weakens. The FOMC and interest rate decisions. The Federal Open Market Committee, or FOMC, meets regularly to decide on interest rates. When the FOMC announces a decision, markets move violently. If the FOMC raises rates, buy USD. If the FOMC holds rates, assess the hawkish or dovish tone of their statement. If the FOMC cuts rates, sell USD. The pro rule: never hold a tight stop loss during news. Here's where risk management meets fundamentals. Never, and I mean never, hold a tight stop loss during a major news event like FOMC or NFP. Why? Because spreads widen dramatically during news. Your broker's spread, which is normally 1 to 2 pips on your USD, might widen to 10 to 20 pips during the NFP release. Additionally, the volatility is so extreme that your stop loss will be hit before the real move starts. And then price will reverse. This is another institutional trap. The institutions know retail traders hold tight stops during news. So they create a violent spike in one direction, hunt those stops, and then move in the real direction. The pro move: close your position 30 seconds before the news, or don't hold any position at all during major news events. Combining technicals plus fundamentals, the ultimate setup. Here's where it all comes together. You've identified a major technical setup on the daily chart. You've found confluence of supply and demand, order blocks, and Fibonacci. The 15-minute boss is forming. Everything is aligning. But then you check the economic calendar and see that NFP is being released in 2 hours. What do? If the setup is already partially executed, close it. Take your profits. Don't risk giving them back in the NFP volatility. If the setup hasn't executed yet, wait. Let the NFP pass. See if the fundamental direction aligns with your technical setup. If NFP is strong, bullish USD, and your technical setup is a USD JPY buy, perfect. They align. Wait for the post-NFP setup to form and enter. But if they conflict, if your technical setup is a USD JPY short, but NFP comes in strong, bullish USD, reconsider. The fundamental headwind might be too strong for your technical setup to work. The calendar is your secret weapon. The institutions know when major fundamental events are coming. They position ahead of them. They create technical setups that are about to be confirmed, or invalidated, by fundamental news. You should too. Keep an economic calendar open at all times. Know when CPI, NFP, FOMC, and other major events are coming. Plan your trades around them, not into them. Becoming the edge, you now have the keys to the kingdom. You understand supply and demand zones, the institutional footprints left behind on price action. You understand smart money concepts, liquidity sweeps, order blocks, and fair value gaps. You know how institutions hunt before they move, and you know how to wait for that hunt before you enter. You understand Fibonacci, not as a magic tool, but as a confluence element. You know the golden zone is where institutions really buy. You understand multi-timeframe analysis. You know that the daily tells the narrative, and the 15-minute executes it. You know that alignment across timeframes is where high-probability trades are born. And you understand fundamentals. You know that CPI, NFP, and FOMC decisions move currencies more than any technical pattern ever could. You have all the knowledge, all the concepts, all the tools. But here's the truth that separates the 1% from the 99%. Knowledge is not enough. Discipline is everything. Discipline to wait for confluence. Discipline to skip the trades that don't have all the elements aligning. Discipline to respect your stop losses. Discipline to trade with a plan, not with emotions. Discipline to manage your risk, always. In our next phase, phase 4, we build your complete trading plan. We'll combine everything you've learned here into a systematic, repeatable approach. We'll cover position sizing, risk management, trade journaling, and the psychology of consistent profitability. But before then, I want to challenge you. Go back to your past 10 trades. Look at the ones you lost. Would they have been winners if you had waited for true confluence? Would they have been winners if you had respected the fundamental calendar? My guess is yes. Most of your losses weren't about being wrong on direction. They were about poor entry timing or trading during conflicting timeframes. Fix that, and you fix your bottom line. So subscribe, join the community. Let's get to work. The Pro Edge is yours. Now use it.